Hello, my name is Andrew Knott and I'm the Chief Executive of Savannah Petroleum plc. And today I'm going to take you through our investor presentation to give people an insight into our business, what we're doing, and how we're trying to create value for our stakeholders. Slide 2 is a disclaimer, which I'd urge everybody to read. I'll start my formal presentation on slide 3, which is the corporate overview slide. By way of background, for those that don't know Savannah, we're a full cycle British oil and gas company focused around the delivery of material returns for our stakeholders through the development and monetisation of high quality oil and gas projects in Niger and Nigeria. We've been listed on the London Stock Exchange for over 4 years now. We've got a very good and supportive institutional investor base, which includes some of the largest asset management companies in the world. You can see at the bottom of slide 3 the names of some of those institutions. And we're now going through a transformational period whereby we're drilling a lot in Niger, we're adding a lot of value through that drilling activity. We're also expecting to pay a maiden dividend in Q1 2019. The board and management team that we have are very experienced. There's a lot of track record there in terms of delivering for investors. And we have a very clear and phased business plan for Savannah in each of its business units. In terms of the asset base ourselves, we combine cash flow generative assets in Nigeria with the potentially world-class R1, R2, R3, R4 PS areas in southeast Niger. Ukwo and Stub Creek, which are the two producing field interests in Nigeria, are large producing low-cost onshore oil and gas fields. Associated with that, we have an interest in the Aki gas business, which is the principal gas processing and distribution business in southeast Nigeria. And then in Niger, we have 50% of the Agadem Rift Basin under license, which has been estimated by CG Robertson independently of Savannah to contain 2.8 billion barrels of yet defined prospective resource. The company itself, in a period of transformational activity, we've drilled 3 exploration wells in Niger to date. Each of them has proven to be a discovery: Bushaya 1, Amdi 1, and Kunama 1. We recently announced that we're extending the drilling campaign to include Eridal 1. And we have 5 remaining options on the existing rig which we can exercise. There's going to be news flow around the well testing program, which will also hopefully lead into an early production system. And then in Nigeria, there's a lot of upside on those assets associated with new gas sales contracts and also just getting more gas through the system. The next slide, slide 4, goes through the intended work program that we have. As you can see, the next major drilling event is the drilling of Eridal 1. We then expect to do a well testing program. Then we have options over the next 5 drilling campaign wells in the drilling campaign. We may acquire some additional seismic, and we may introduce a partner. In Nigeria, similarly, there's some drilling activity, there's completion of the transaction, and then there's also at the corporate level the payment of a maiden dividend in Q1 2019. So for Savannah as a corporate, there's an awful lot going on, which we believe will add a lot of value to the company. The board of directors, I think, is a key differentiating factor. As you'll see by looking through the CVs of those that are involved in the company, we have people with a geological, an engineering, a legal, a finance, and political background, and I think is a very good mix of skills to have on the board. Fast forwarding to slide 7, we're starting to talk now about the 3 discoveries that we've made. As you can see, they're called Bushaya, Amdi, and Kunama. You can see pictures of the oil that we've recovered to surface, and you can also see stylized log cartoons which show where we found oil across the 2 wells. Slide 8 talks through the operational performance that we've achieved as a business in Niger, and I think it's something that we're very, very proud of. What you can see very clearly is when we've done our operations, they've come in under budget and under time, which is really very, very important, certainly for myself as the chief executive, in terms of the culture that we try to create in the company is of delivering projects to budget. Slide 9 starts to talk about the Niger project and why we came here originally. So the Niger acreage is over 30,000 square kilometres in terms of the size of the basin. To put that into context, that's about 1.5 times the size of Wales. You can see from the picture on slide 9 a blow-up of the basin, which, to orientate yourself when you're looking at it, blue are the structures that Savannah's identified from seismic that are interesting to consider drilling. Green are the existing discoveries which exist in the basin, including the 3 which have been made by Savannah. The permit areas that Savannah has are R1 and R2, so R1 is in the northwest, R2 is in the centre of the basin, R3 is in the southwest, R4 is in the southeast. You'll also see that it's blown up from a map which shows the wider Central African Rift System, which is a series of Cretaceous and Tertiary age rifts, which have proven to be very prolific for oil. So North, South Sudan, Bongo and Doba basins in Chad, and then ultimately the Agadir Rift Basin in Niger. One thing I would point out that is very, very important about this area is everywhere you found oil is currently in production today. And something that we believe in our company is you can find as much oil as you want, but if you don't get into production, it isn't worth anything. And this is an area where if you find oil, you're able to produce it. The history of the basin itself: 2008, CNPC, the Chinese National Petroleum Corporation, entered Niger. They licensed the basin up, they paid the government a large signature bonus, and they've then undergone a 74% exploration success rate. That's more than 220 wells have been drilled, that's 1 billion barrels of 2P have been established, very large amount of seismic data has been acquired, infrastructure has been put in place in the basin, including a pipeline to an oil refinery. And then what happened is, same for any, well, not for any, but for the majority of PSC areas in the world, there was a mandatory relinquishment program. Savannah came in and we acquired R1, R2, and R3 and R4 from the government after they were relinquished. We've then gone through our own phase of doing an extensive geological evaluation, and then at the beginning of the year we started our exploration campaign in an area called R3 East, which on the prior slide, on 2 slides before slide 7, you can see the zoom in of R3 East, which is located just at the bottom of the, it's the substantial block at the bottom of the R3 permit area, which you can see on the map on slide 9. Slide 10 talks about why the success rate is so high in Niger and the basin itself. Anytime you try and find oil, and when people talk about the risks associated with oil exploration activities, the mathematical risk is the product of the risk of source and migration times the risk of reservoir times the risk of trap. So source and migration is, was oil generated and where did it go? Reservoir is what are the quality of the rocks oil has potentially been trapped in, and the trap is what stops the oil moving any further. In Niger, what you can see very clearly from the data we've provided on slide 10 is there's been a lot of oil generated in the basin, and it's been proven to be able to migrate to most areas of the basin already. That sort of covers your source and migration risk and why the view is it's very low. From a reservoir perspective, every well that we're aware of that's been drilled in the basin has found reservoir quality rock. And we've done a lot of analysis on this, so we're very confident that throughout the basin there's reservoir quality rock. And then from a trapping perspective, there's really 2 things which serve to de-risk an individual exploration well. The first is you get a lot of shots at the dice. So, for example, within the main clay, the soccer alternances within Niger, you have between 5 and 6 reservoirs, all of which have the potential to be trapped. And they're largely independent of each other. Therefore, it just statistically means you're much more likely to be able to find oil because you've got these additional shots of the dice. The second thing is, because you've got a high quality data set, you can properly image, or you can image to a very high degree, whether you believe there's going to be a trapping configuration when you drill the well. So again, those 2 points combine to create a much reduced trap risk. So essentially, at a high level, the key takeaways from this slide are you have relatively low source and migration risk, relatively low reservoir risk, and relatively low trapping risk in the main structural play within the Agadir Rift Basin. Secondly, in terms of the remaining opportunity to go by, you can see that from these seismic lines, the sorts of structures that we're identifying on our seismic is very similar to the sorts of structures which have resulted in discoveries elsewhere in Agadir. We could show multiple seismic lines, all of which will tell the same story. Slide 12 talks about, again, the remaining opportunity, and it shows statistically the creaming curve. You can see it's not creamed, i.e. the rate of discovery is not declined over time. On the right-hand side, which is a very bullish signal, on the right-hand side, what we can see is a comparison of Agadir to the UK portion of the Central North Sea. Now, this is somewhat of an extreme comparison because the UK North Sea has been super capital invested. You have 61 proven play types, but in Niger you only have 6 proven play types, of only one of which is the Soccer Alton, has seen any significant attention. So in geology, this doesn't really happen. There will be more geological play types over time, in our view, that will emerge, and you'll certainly see a lot more than one primary play type being the focus for development activity. To this end, the analysis that CGG Robertson have done has identified a very large yet to find prospective resource space within our permit areas. The message here is that it's low risk and there's a very large opportunity that we have available to us. Slide 13 is a little bit more technical, and what it tries to do is explain how the geology all links together. What you can see is a cartoon of this, of how the geology links together. So within Niger, the primary focus of interest historically has been in this play, the Soccer Alternances. These are rocks which are Eocene in age, and on this cartoon are labelled E1 through to E5. In some parts of the basin there's also an E0, but that's not consistent throughout the whole basin, but E1 to E5 appear to be consistent throughout the basin. And what you see is oil is generated at depth in the Yogu source rocks. It then migrates upwards into traps in the Yogu, traps in the Eocene, and then some shallower traps also. And what you can see is the trapping mechanism in the primary play is that you have a situation where you have sandstone, which is depicted in yellow, trapped across a fault against shale, which serves as a seal. And that's a very well understood trapping structure configuration, and that is the primary focus of the wells that Savannah's focused upon. As I said before, because you're dealing with an E1 to E5, you have a lot of shots at the dice. There are also potential in the shallower and deeper horizons, which we may or may not target going forward, but the primary target that we expect to remain focused on is just in the Eocene Soccer Alternances. So moving forward to slide 14, we talk a little bit more about the reason why we started in R3 East and what we want to do going forward. There are several reasons for why we started in R3 East. First, it's a geological sweet spot of the basin. The success rate with offset wells is 93%. We're directly on trend with some of the largest producing discoveries in the basin, which is Gumeri, Agadi and Sokar, which are shown in the map on the right hand side. And we're also located in close proximity to existing production infrastructure and logistical hubs. So it was a natural place to start, not least because there's a lot of prospectivity that's been identified within this area. In terms of the forward drilling plans, as we look at it today, we're going to be drilling Eridal. There's another, which is in close proximity to Amdi. There's another structure in close proximity to Amdi called Zomo, which if we were to exercise additional options would likely be the next well that we would drill. And then the choice would be between moving the rig to R3 Central or drilling additional producer wells in some of the existing discoveries that we've made. But that decision has not been made at this point in time. Moving forward to slide 15, as I said before, and I think it's very important, there's a very big focus in our business around monetizing these discoveries. So that comprises two things. The first thing is putting in place an early production system. The second is participating in the export solution. There's spare capacity in the domestic refining system today in Niger. There's also spare capacity in the refining system in northern Nigeria. So how we commercialize our discoveries, the focus just now is around the opportunities to get into the regional refineries through either through leveraging existing pipeline infrastructure or using trucks. and I expect to be able to update that later in the quarter in terms of exactly how we see this working. But rest assured, it's a major focus for us as a business. So to summarise, in terms of Niger, we're 3 from 3. We've got a very large opportunity set in terms of drilling targets going forward. We're focused around delivering the first production. The operating environment is benign, and it's shown very clearly in the way we've managed to deliver our operations on time and budget. Very high success rate in the basin, and the finding cost is very low. So really, we're in a very unique position to have such a large asset where we think we can have repeatable success, that we think it's going to be relatively straightforward to deliver cash flows from, and not very expensive to do so either. So it's an asset we're very, very excited about, and we're very proud to have in our books. Moving on in terms of where we are in Nigeria, the first thing is, why did we come to Nigeria in the first place? This is slide 18. So why did we come to Nigeria? Firstly, it's a very strong cash flow jurisdiction. The industry on average generated 40% more cash than it's invested in any given year for a very long period of time, as you can see from the graph on the top left-hand side. Secondly, there's a strong opportunity for consolidation. There's a lot of opportunity whereby smaller companies are asset rich, cash short, and they are seeking a high quality partners to come and partner with them in opportunities. There's a whole large divestment program which has been run by the major oil companies, and the government itself is the holder of a significant undeveloped field resource, which means there's a lot of supply, and currently in Nigeria today there's not a lot of demand. There's not a lot of competition with other companies trying to expand in Nigeria today, so that creates an opportunity, we believe, for a company like Savannah. The geology itself in Nigeria is some of the best in the world. It's one of the most oil prone and gas prone delta systems in the world. The country itself has proved reserves of over 37 billion barrels of oil and over 187 TCF of gas. And there's significant upside, with numerous surveys indicating billions of barrels have yet to find potential in Nigeria. And then lastly, you've got a fully established oil and gas industry. You have average capex in Nigeria of over $7 billion, and the vast majority of oil service companies globally are available. So if you want to do something, the equipment is available for you to use in country. In terms of more specifically what the assets that Savannah's interested in, i.e. the 7 assets, slide 19, there's a picture of a map of the assets, which we'll talk through in a second, and then there's some key snapshots in terms of what the assets are capable of doing in the graphs that surround that picture. So if you look at the picture on slide 19, the green block is the Uko field. Uko is the current cash generator of the business. It's in production for liquids and it's in production for gas. Liquids are sold to the Kwaibo terminal, which is operated by ExxonMobil. The gas is sold to the Akigas pipeline network, which is the red pipeline network in the map. The Stub Creek field is a large gas field, but it's currently in production for oil. The expectation is that when the Uko gas comes off plateau production, Stub Creek will come in and backfill that gas, which will enable the gas contracts to be serviced. The commercial relationship is that the gas from the upstream is sold to Akigas, which is the midstream business, which Savannah has an equity interest in, and then the midstream business then onward sells that gas to 3 separate customers: the Calabar Power Station, the Unizem Cement Factory, and the Ebon Power Station. What we have 92 million barrels of oil equivalent of 2P reserves and resources. Reserves, 44 million barrels of 2C resources. The production profile is indicated on the graph below. The gas price that we have is fixed but rising at an average of 5 to 6% inflation, so very strong revenue growth expected from that. The quality of the revenues is such that 92% are sold to investment grade credits, not least because the Calabar Power Station sales are covered by a World Bank partial risk guarantee, which effectively provides a AAA guarantee to those sales. And then slide 19 shows the underlying, the last graph shows the underlying oil price sensitivity. Because you're largely fixed price gas, the Nigerian business has a relatively limited oil price sensitivity. For every 30 basis points for every 100 basis points move in the oil price, cash flows move by about 30 basis points. I.e., if oil moves by 30%, cash flows move by 10% on average. Slide 20 runs through the netbacks. As you can see, this is the oil and the gas is profitable, and there's pictures of the facilities, both Uco and Stub Creek facilities. Slide 21 starts to talk about the upside and the real focus in terms of delivering incremental value from the business. And it's all linked to AccuGas. So the AccuGas business, which is the gas processing business and transportation business, so processes it, cleans up dirty gas so you're able to sell it to customers, transportation, it takes it to the customers. The way there's a very advantaged business, so it's the largest processing and transportation business of its type in southeast Nigeria. In very simple terms, there's a very large amount of undeveloped gas sitting in very close proximity to the infrastructure, roughly 40 TCF. The obvious place for that gas to be developed, any of that gas to be developed, is through this infrastructure. From a customer perspective, upstream currently sells gas for $1.70 to midstream. Midstream sells gas for $3.50. These are all weighted average prices to its customers. But the competing source of power in the area is diesel. The price associated with that is greater than $10 an MCF equivalent, much greater in some cases. So it makes a lot of sense for both the AccuGas business and the industrial customers for there to be a switch from diesel power to gas power. To that end, Seven Energy, the business that we're acquiring the assets from, signed a series of heads of terms with industrial customers at $7.50 an MCF. What that means in very simple terms is that if that was to happen, the upstream would see a doubling on its realised margin, more than a doubling on its realised margin from the incremental production that it delivers, and the customers would still receive a significant reduction in their cost of power. On top of that, Nigeria is a country with very, very high anticipated power demand growth. So we think we're going into a business with very, very good fundamentals and a lot of advantages versus competitors in terms of being able to deliver the growth. In terms of the value and upside opportunity, we're paying about $280 million to acquire these assets. Our CPR value to this is at over $600 million. But there's a lot of upside which isn't in the CPR valuation which we're chasing. So you have the AccuGas story which we talked about, you have the Stub Creek gas commercialization story, and then there's also additional resource within the license areas which currently hasn't been drilled, hasn't been gone after, which if we so chose could add significant value as well. So that's really a summary of where Savannah is. Both businesses, both Niger and Nigeria, have a lot of upside. There's a lot to go after. We have a management team that's capable of delivering that. We have a strong financial backing from our existing institutional investors. And there's going to be an awful lot of news flow coming through the business, both in Nigeria and Niger, over the course of the coming months and years. So anybody who has any questions, you're more than welcome to send in requests to our IR team, which is ir@savannah-petroleum.com. In today's presentation, I haven't covered the appendix slides. I would highlight that there are a series of additional information slides in the actual presentation itself, which is available on the website. So for those that are interested, please download the presentation from our website and you'll see the additional appendix slides.